Why do markets exist? Part 2. Yesterday I posed the question, why do markets exist? In our video yesterday, we brought up two important points. First of all, markets are not a casino. They actually serve a purpose in society. And that purpose is markets exist for the commercial firms that use that market to hedge their risk. If commercial firms do not use the market to hedge their risk, the market fails. It won't make it. Speculators are not enough to make a market work. The second premise is that every market has an intrinsic value. The idea that the market is a zero-sum game is a false premise, because every market has an intrinsic value that is literally created from nothing, and money is made or lost around that intrinsic value, but the intrinsic value itself can go up or go down. This is an important premise because it supports the concept of abundance versus the concept of lack. Now, taking those two concepts forward into today, we're going to continue the discussion. First of all, we're going to continue to discuss the commercial user. And actually, before we even get into that, I think it's important to define what is gambling and what is trading. So, gambling is a game of chance. Gambling is a zero-sum game. For every dollar bet, there is a winner and there is a loser. And money is exchanged around that outcome of the bet. So, it literally says to play any game of chance for money or other stakes, or to risk money or anything of value on the outcome of something involving chance. That's the key part. So there's no value created in gambling. It is a zero-sum game, and the outcome is based solely on chance. Trade is very interesting because a trade is an exchange of value of one thing for another. So every time we make a trade, we exchange something in value to gain something in value. So if we buy a stock, we give currency in return for stock certificates. If we buy a commodity, we exchange currency for the right in the future to own a commodity, to take delivery of a commodity. So there is a trade. There is an intrinsic value to every transaction. That's really important to understand. Now, once we understand that, then we can go back to our commercial framework. So everybody thinks, well, for every buyer, if somebody buys at a certain price and it goes down, they lose. And if it goes up, they win. It's not true. It's not true at all. We said that the primary use of the market is to be a place for commercial firms to hedge their risk. So what's really interesting about this is that if I am, let's say, Southwest Airlines. If I'm Southwest Airlines, I have consistent need for jet fuel. And I can hedge that risk a number of ways. I can literally go into the over-the-counter market and I can buy jet fuel. Or I can be more broad and I can actually buy crude oil. But if I'm Southwest Airlines, my primary job is not trading crude or jet fuel. My primary function is to fly people from point A to point B. And the price of jet fuel is just one input among many that drive my cost basis. So, what you'll see in the energy market is as prices tend to go lower, you'll see airlines like Southwest Airlines start buying more and more crude, more and more jet fuel. And why is that? Because as price goes down, their price for a ticket stays the same. They're still charging $400 for a coach ticket, while the input of fuel is getting cheaper. So what that means is their profit margin's actually getting bigger. They're making more money. So as price goes down, people are like, well, somebody's buying, they're getting killed. No. Southwest Airlines is buying more and more fuel because as price goes lower, their profit margins widen. They get bigger. So their appetite to buy increases on a break. We have other parties, let's say like a farmer or an energy producer. Let's just say an energy producer. And the price of crude goes up. Well, they have the same cost to pump the crude out of the ground, costing the same amount per barrel. So as the price of crude goes up and up and up, their profit margins widen. So they get more and more excited to sell. So people see them selling, like, oh, they must be getting killed. No, they're not getting killed. They're making more money. The higher the price goes, the wider their profit margin, the more profit they have. They love that. So this is important to understand because, like I said, the market is not a zero-sum game. So the second aspect is, as we talk about this actually gives us a sense of how price acts. So if we are Southwest Airlines or we're ExxonMobil, we have a model for what fair value is. We have all these inputs. So we know what it costs to move crude oil to Cushing, Oklahoma, let's say. We know the cost of financing. We know the geopolitical constructs. We know all these different aspects of the inputs, and we use this to create a fair value model. And so the cheaper it is to fair value, the more we want to buy it. The more expensive it is to fair value, the more we want to sell it. So this is important to understand. With the market, if we look at the market's job is to facilitate trade. That is the primary function of a market. The market's job is to facilitate trade. So if it's at a price where it won't trade, there's not buyers and sellers, well, the market is going to move to go find buyers or to go find sellers. So if we open up at a level that there's some sellers and no buyers, price is going to go lower to find the buyers. So this is important to understand. We're building this whole framework of value and the facilitation of trade because it gives us an understanding of how prices move. So the average person sees price going up and they're like, well, this is my chance to get rich, so I'll buy it. And they don't realize that they often are buying it from a commercial who knows way more about the product than they do. We talk a lot about the concept of fair value. So fair value is the balance of supply and demand. And that fair value is elastic. It moves. And different time frames have different fair values. So this is important to understand for trading because this gives us an edge. If we're able to buy cheap, buy low, sell high, we actually start to get an edge to fair value. So this is something I want you to think about because this should make you start to think of the market differently. People just say, oh, I think it's going up, I buy it. And they don't even think about, what is a commercial firm that knows everything about the product and they're the ones selling it to you? What does that tell you? It tells you your trade is shit and you're in trouble. That's what it tells you. Okay? So what's really interesting with cryptocurrencies is, and you look at the crypto space, saying cryptocurrency, crypto's vast. There's so many different aspects of this technology. But one of the questions you got to ask yourself is who is the natural long and who is the natural short? And do those natural longs and shorts have a desire to use that market to hedge? So in some cases it's definitely yes, in some cases it's definitely no. That's why you're seeing some of these smaller coins, you'll see them explode and you'll see them collapse. Because there's no commercial trading them. It's just all speculation. It's the greater fool theory. I'll buy it and I need to sell it to somebody before the whole thing collapses. So anyways, I want you to think about this because this is a powerful framework to think through to trade successfully. This is how pros think. Pros don't think about price. Pros think about value. So with that, we have our next Red Pill Challenge coming up on February 18th. If you go to tradingmatrix.com, we have a free lesson for you that starts to get you initiated to the Matrix Money Machine. start to understand what we're doing there. And we will be having a free webinar this Thursday at 6:30. We'll post the link here. You can sign up for that webinar and find out more about what we're doing. Hope you all have a great night. God bless, and I will see you tomorrow. Bye.